Nice to meet you. So you said I should be able to see at least the people, at least about 55 or 60 people from, so I can call in those people, right?
Yes, sir. They'll be soon joining in, sir.
Okay. And the rest, are they going to be just able to ask questions on chat, or what is the process by which box should I have open? The Q&A box, the chat box, or what's the process by which other participants will be able to join in?
Yes, sir. Q&A box would be Q&A box would be the right box to open. We have also collected few questions which I have shared with Deepak. So Deepak and Professor Kakani.
So Deepak, are you going to be then the conduit for the questions that come from the audience? So I'm not reading the Q&A questions then, right? I can shut the box.
Yes, sir. Me and Professor Kakani will ask.
Okay. I just want to check my screen sharing to make sure it's.
So just 3-4 minutes and we'll start off at 8:30.
Okay.
Sir, Professor Kakani is here.
Good evening, Professor Damodaran.
Hi, how are you? You guys are all dressed up. I'm not. So it's 8:30 at night. Why are you all, you're wearing your ties still?
Well, I guess it's been a little late. That's it. But I guess it's the local festival out here. Today is the first day.
Independence Day, right?
Onam.
Oh, is it? It's past Independence Day. It's August 18th. Never mind.
Yeah, Kerala has the local festival out there, Onam.
Okay.
So that also becomes a reason for us to be here. A little dressed up.
Is that the campus behind you?
This is this is the campus. Of course, what I have is an image of the campus, but we'd like you to be here someday, sooner than later.
Someday. I haven't even been back to IIM Bangalore since 1979 when I left the school. So
Oh,
I haven't been back to an IIM campus since 1979.
yeah. I think Bangalore's kind of done extremely well for itself in the last few years.
I've never seen the campus because the IIM I went to was actually the rented property inside the city. It was a small, it wasn't even a school. It was just they rented a building for it. So I've never seen the campus.
Oh, okay, okay.
So it's 8:30. Shall we start?
Ready.
Good evening, everyone. It is my pleasure and honor to welcome you to today's leadership talk. I would now like to welcome our finance professor, Professor Ramkumar Kakani. He has pursued his doctorate in management from the IIM Calcutta, and from there his career as a teacher, mentor, and coach began. He has worked with various educational institutes such as XRI Jamshedpur, SP Jain Center of Management Singapore, and LVS NNA, and is associated with IIM Codicor since 2019. He has taught us the essentials of financial accounting and analysis during a first term, and we have observed him closely. From dreading the assignments after every class, listening to his opening statement of Dear Janta, and fearing the cold calls, we have learned a lot from him. We feel proud to be associated with you and derive happiness by being college students, sir. Without taking any more of your time, I would request Professor Kakani to introduce our guest for tonight, Professor Aswath Damodaran, also known as the Dean of Valuation.
I'll fail. Good evening, friends. I'll fail in kind of making error if I do not accept and say that upfront that almost all of us here, if we are investment bankers or have done anything with related to valuation, investments and valuation books of Professor Damodaran are like Bhagavad Gita. And we kind of have been going through it. So I think that's for me, that's the introduction. I would say a very quick introduction out there. And people dream of careers, academicians dream of great things. And I can assure you that, for example, the way Michael Porter is for marketing, similarly for corporate finance and valuation, we've got Professor Damodaran out there. So sir, all yours, I won't take much time. Over to you. Only condition is for those who are asking queries in the end, their video should be on, right? Sir, over to you.
Okay, thank you. Let me share my screen because does everybody see my screen? Hey guys, how are you? I have a request of you. If your video is off, please turn it on because I like to see you. So it's the thing I miss most about teaching online is you don't realize until you don't do it how much you depend on visual cues to to get whether people are actually understanding what you're talking about. I tell people, you can do whatever you can, but your eyes will always give away when you don't get stuff. So I'm going to be looking into your eyes. If you're falling asleep, I will be noticing you're falling asleep, but don't worry, I understand it's late at night. So be ready, because I'm going to turn some of these questions back on you. So if you're expecting an hour of sitting there and I'm going to just dump knowledge, just give up on it. I don't have that much knowledge to dump. In fact, I can't live down this Dean Evaluation thing. It was actually a lazy CNBC anchor who did this because he couldn't pronounce my name. This was about 10 years ago. So because he couldn't pronounce my name, he said, Dean, he thought that was an easier name, and somehow it stuck, I wish I'd been called the Beyonce evaluation or the Kim Kardashian evaluation. I'd have preferred that choice. But how much time we have? We have about an hour, right? Is that right? Okay, so let's get started. We have a lot to talk about. I could go free form here and just open up to Q&A. I'm sure you could fill up the hours. So what I thought I would do is talk for about 25 or 30 minutes, laying the foundation. And essentially with that foundation, you can launch off and talk about pretty much anything you want. What I thought I would focus on is what is perhaps the hardest concept in corporate finance and investing right now. It's ESG. You've heard of ESG, right? Viresh, what's ESG? Unmute yourself and you can sing.
Yep.
What is ESG?
Sanmi, you may just go ahead.
You can't unmute yourself, or you? I'm sorry. If you can't unmute yourself, I won't call on you. Can people unmute themselves, Sanmi?
Yes, sir. Once they raise their hand, we can.
Okay. But when Viresh, why don't you go ahead? Can you unmute Viresh if you could? Because don't worry, Viresh, I'm not going to pick on you for the rest of the class. I just want to, pick on somebody to begin with. So you were the candidate. So what's ESG? No, you're still muted. Let's see.
Okay, I'll answer on his behalf. He's just messaged me. It's environmental, social, and governance.
So basically, we want companies to be good companies, right? It's extension of what we see in church and temple. It's like, we want it. And if we're going, if you're religious, what is the payoff to being good? There's heaven and there's, everlasting life or whatever you're looking for. So what's a sales pitch that you hear from consulting firms and from people for ESG? That if you're a good company, you're going to be worth more. If you're a good company, investors are going to make higher returns. This is so good if it's true, right? You can be good and be rich at the same time. Now, I think one reason a lot of you are at this age, a lot of 25 to 30-year-olds are really excited about ESG, is they think they discovered morality only in this generation. They think that people who came before them were these immoral, unethical people, and that they've somehow discovered the load of, hey, we're going to be moral people. Hey, guess again, people have always had this urge to be moral. The only difference was in the 1970s, if you wanted to live a moral life, you know what you did? You went and worked for the Peace Corps. You got paid a pittance, but you were doing good. You know what the problem is? Today, people want to work for the Peace Corps, but be paid like bankers. You want the best of both worlds. You want all the benefits of being on that moral platform, and at the same time being able to say, hey, you know what? I get paid $200,000 a year by Goldman Sachs. I'm skeptical about any concept that takes off this quickly. So, in the words of Shakespeare, I don't come to praise ESG, I come to bury it. I think it is the most overhyped, oversold concept I have seen in the history of investing in business. So let's get the show on the road with some basics. How many of you have valued companies? Just put up your hands if you value companies. Anybody have valued companies in your class? Okay. Other than the professor, it doesn't look like any hands are going up. So, okay, Vinay, valued a company. So exactly what do you do in valuation? What is that? Is it, or Saurabh? What is valuation involved?
We do the cash flow FCFF, the DCF valuation. Recently, we have done for a tire company, BKT Tires.
So you've been an Excel ninja, is that what you're telling me?
Yeah, we even saw your Zomato valuation. It's really good, sir.
So in the last 40 years, you basically have been taught to build big spreadsheets and you project things out. But if you cut to the core of those spreadsheets, you're basically answering 4 questions about the business you're trying to value. So pick whatever your business is, whether it's ITC or Zomato, I don't care, either end of the spectrum. Here are the 4 questions you're asking about the business. What are the cash flows you're generating from the investments you've already made as a company? If you're ITC, that's a bulk of your company, right? Your investments were made 30, 40, 50 years ago. The day you invented Charminar was the day you essentially created this gold mine you've been living on for the last 5 decades. What are the cash flows you generate from existing assets? Whereas if I ask that question about Zomato, what's the answer right now? What are the cash flows you're generating from existing investments? Big negative cash flows, right? Doesn't make them a bad company, but that's reality. So you've got ITC, big pause. I'm not making a moral judgment. It's great to have a product or a service that's an addiction. If Morgan Stanley could addict you to structured products, would they do it? In a second. The only reason people point at ITC is they wish their product were addictive because then everybody would have to buy it no matter what. What are your cash flows from existing assets? So when you pour through existing financial statements, what are you trying to do? You're trying to get a sense of what cash flows is this company generating from its existing assets. That's the easy part of valuation. Now comes the part where people start to get uncomfortable. Second question I want to ask you is, what is the value that you will add or destroy from future growth? It's a strange question, right? Because what have we all been trained to think? Growth is good, growth adds value. But growth is a double-edged sword. The good side of growth is your revenues get larger, your earnings get larger, your cash flows get larger. That's a good side. You know what the bad side of growth is? You got to invest money to get that growth. You got to build plants and factories and open stores. Already you can see that growth can add value, do nothing for value, or destroy value, depending on how much you're investing and what you're getting back. This notion that growth is always good is one of the most dangerous notions in business, but it's deeply said. How many CEOs talk about shrinking their business? Every CEO says, I want to grow my business. I valued ITC 2 years ago. And I said, this is a business that lives off its cigarette business. Everything else that ITC has done has been a value destroyer. Name me one thing it does other than cigarettes that creates value. If you were a stockholder running ITC, you know what you'd have done? You'd have gotten out of the hotel business. Who wants to be? It's a horrifically bad business, especially in India where real estate costs so much. You're locking in these huge infrastructure investments, and God help you if COVID hits and nobody's coming into your hotels. For ITC, growth for the last probably 20 years has been value destroying, which raises one of those puzzling questions in business. Why do companies in value destroying businesses continue to pour money into those businesses and try to grow? Because we're programmed to think that growth is good. Let me ask you a question. When was the last time you saw a movie about a CEO who made his company smaller? I remember that movie about Steve Jobs. We worship empire builders. Every case study you read is about companies where the CEO came in and made the company bigger. There's a reason Jack Welch and Steve Jobs became legends. They took companies that were small and made them big. For once, I would love to see a movie about a CEO who comes in a company in a bad business. And trust me, in India, there are lots of bad businesses. And says, you know what? I'm going to make this company smaller. We reward CEOs for empire building. We don't reward them for accepting reality and saying, my company's best days are behind it. Get smaller. What's the value add? And you can see why this makes you uncomfortable or should make you uncomfortable. Because to value growth, what do you need to do? You need to play God. You need to forecast the future. We do this all the time in valuation. It freaks us out more than we would like to. And depending on your perspective, it freaks some people out more than others. You know, the people who have the most trouble with valuation. I'll give you my history. I went to IIM Bangalore from 1977 to 79. There were, I think, 93 people in my batch. 91 were engineers. I was one of the 2 non-engineers. And you know what? I had an incredible advantage over these guys. Because they were so used to 1 + 1 is 2. And if you threw them something that they couldn't handle, imprecision, uncertainty. Let's face it, if you're a numbers person, and many of you have numbers degrees, uncertainty makes you uncomfortable. For some of you, that barrier is insurmountable. Trust me, you shouldn't be doing valuation. Go do something where at the end of the process, you can say, I got the right answer. Congratulations. Pat yourself on the back. Become accountants, auditors, actuaries. Don't go into valuation. The nature of valuation is you're going to be wrong. You know what percentage of the time? 100% of the time. And let me explain what I mean by 100% of the time. I have never, ever in my lifetime valued a company where every single cash flow came in exactly as predicted. If it happened, it would freak me out. That'd be like a Twilight Zone episode. You don't have to be right to make money. You just have to be less wrong than everybody else. Remind yourself of that basic truth every time you invest. You know, when I did my Zomato valuation, I heard from quite a few people. And some were borderline insulting, but I don't care. I mean, I have a thick skin. And the core question was, why would you invest in a company when there's so much uncertainty? I said, it's precisely because there's so much uncertainty that I'm going to invest in this company. Because people are giving up. No, I mean, do you really think the people buying Zomato shares right now are doing an intrinsic valuation of the company, thinking of its business model? They're not. They're trading the stock. You know what the difference between trading and investing is? How do you make money trading? You buy at a low price, you sell at a higher price. All you need is somebody else out there who will pay you a higher price. It's very simple. In many ways, it's much more honest than investing because you're not playing games about cash flows, growth rates, business models. It's buy now, sell a few weeks, few days, a few months later. So even though you're going to be wrong, you have to try to assess the value of growth. So when you do with cash flows, tell me where growth shows up. It shows up in your growth rate, obviously. It also shows up in its twin variable. You know the twin variable with the growth rate is? Whenever you think about growth, what do you have to think in tandem in your cash flows? You have to think about how much you need to reinvest. You can't talk about one without the other. There's a reason banking valuations are so divorced from reality. Because you play line item games. You know what line item games are? You sit there with a line and say, what can I do to this line item? Oh, I'll make the growth higher. If you leave everything else alone and you make the growth higher, guess what? Your value will always go up because you created a machine, a magic machine that creates cash flows out of nothing. The third question you try to answer in valuation is how risky are your cash flows? Notice how I did not phrase that question and ask you, what's your beta? What's your risk premium? I mean, these don't mistake models for principles. The first principle in valuation is risk has to become part of your value. Riskier cash flows should be valued less than safer cash flows. That's a common sense proposition. It's got nothing to do with modern portfolio theory. But then raises a follow-up practical question. How do we measure risk? How do we bring it into the discount rate? And this is where all the different risk and return models play out, right? CAPM, arbitrage pricing model, multi-factor model. But the reality is, what are you trying to do? You're trying to bring risk into your discount rate. About 3 years ago, I've been every couple of years or so, but I haven't in the last couple of years. I've been to Omaha. You know what happens in Omaha every year, right? It's value investing Woodstock. It's basically people who flock to Omaha from all over the world to worship at the feet of the two value investing gods, both in their 90s, Warren Buffett and Charlie Munger. So about 3 years ago, they invited me to come and talk. I don't go to the meetings themselves, but to come and talk to the portfolio managers. Remember, these are true believers. So ask them, your value investors, how many of you value companies? You know how many value investors actually value companies? Almost none. They say, but the value investors, the way they value investors, they buy low PE stocks or low price to book stocks. They look for a metric that they think stands. It's incredibly lazy if you think about it, right? Because you're letting a metric stand in as your measure of value. By that measure, you'd have loaded up on ITC and you'd have stayed with ITC for the last 6 years because relative to other Indian stocks, it always looks like a bargain. So I said, why don't you do discounted cash flow valuations? You know what the most common reason was? Because we don't like betas. I said, this is the stupidest reason I've ever heard. You don't like betas, use some other metric for risk. If you think risk is better measured by, variance in earnings or how stable or predictable your earnings are, how often you lose money, you can use that. Instead, all that discounted cash flow models require is that you come up with a risk assessment, that you build it into your value, not that you have to use betas. People are always surprised when I say, you don't like the CAPM. Okay, I don't like the CAPM either. So give me a way of measuring risk and I'll do a discounted cash flow valuation. I'm not dependent on having a beta or risk-free rate. I just need a sense of, is this a risky company? Is this an average risk company? I want to bring that into my valuation. So what are your cash flows of existing assets? What's the value added or destroyed by future growth? How risky are your cash flows? And there's a final question. And this always puzzles people and asks this question: when will your company become a mature company? Your first reaction is, what the heck is a mature company? A mature company is one that grows at a rate less than or equal to the economy. Saying, why do you need to know? I'll tell you why. I have a math problem. I'll tell you what the math problem is. The value of an asset is the present value of the expected cash flows on that asset over its lifetime. So if you gave me a 10-year project, say, what's the value of this project? I'm going to take the cash flows for the next 10 years. I'm going to discount the cash flows. I have a value for the project. 5-year cash flows. You know what the problem you face when you value publicly traded companies is? What is the life of a publicly traded company? Open up a corporate chart for a company. It tells you when the company is founded, right? When does it tell you the company is going to be wound up? It doesn't mention it. So at least in theory, what do you need to do? You need to estimate cash flows forever. This is my vision of hell. You show up in hell, you're given a computer and an Excel spreadsheet, and the spreadsheet goes on forever. You're in column 16,484. You can see why people, when they value companies, constantly stop. Can I stop now? Can I stop now? And I'll give you an answer, and you're not going to like when you can stop. You can stop if you're willing to assume that beyond that point in time, your cash flows grow at a constant rate forever. You know what that buys you? It buys you an infinite series in mathematics. Because think about it. No, 1 plus g, 1 plus g squared, 1 plus g cubed, going on forever, 1 plus r, 1 plus. So basically, it's 200 years ago, mathematicians solved for the value of that infinite series. You know what we did in finance? We stole that equation from mathematics. We act like we invented it. And you know what it shows up in your valuation? As your terminal value. So when you take that cash flow and divide by R minus G, remember you're carrying 200,000 mathematicians on your back, and you better not screw up. Because when you use that equation, it comes with a catch, which is your cash flows have to grow at a constant rate forever. Now, I'm going to say something that I'm surprised I have to even defend, but it's amazing how many CFAs and portfolio managers say, tell me why again. No company, that cash flow growth rate cannot exceed the growth rate of the economy for any company. I don't care how great you are as a company forever. And there's no finance reason for it. It's a math reason, right? And you know why? If I have two numbers and I let one number grow at a higher rate than the other number and let it happen forever, eventually what's going to happen? The company is going to become the economy. Then what? Oh, globalization. Let's keep going. You become the global economy. Then what? Interplanetary travel. I mean, there's a cap on your growth rate. You know what this last question allows me to do? It allows me to stop and estimate a terminal value. Now, don't play games with me and say, I can use a multiple and use EBITDA. If you do that, don't call this an intrinsic valuation, just a forward pricing. 80% of banking valuations are called discounted cash flow valuation, but they're really pricing in drag. Because the biggest number is the terminal value, comes from applying a multiple. That's not discounted cash flow valuation. When I look at a valuation, those are the questions I'm trying to answer. And of course, we build really elaborate models. You know why? Because we can. I did my first valuation. I'm going to give away my age by telling you what I had to use. I had to use a calculator, not a slide rule. I'm not that old. And a ledger sheet. You guys even know what a ledger sheet is? You know what the great innovation of a ledger sheet was? The lines came pre-drawn. I used to hate drawing lines for the columns. The ledger sheet came with lines drawn. I valued my first company with a calculator, a ledger sheet, and a pencil. You know why a pencil, not a pen? Because you always had to erase and change numbers. And God help you if you wrote in pen. And so basically every number had to be hand calculated. When you value companies with a ledger sheet, a pencil, and a calculator, you will never have 500 line items in your valuation. Think about it. If you have 500 line items in 10 years, how many numbers will you have to hand calculate? That's 5,000 numbers. Valuations in the early 80s were parsimonious, not because people were stupid, but just every number had to be hand calculated. Today, think about how we do valuation. Last summer, my son was an intern at a hedge fund, and he's a rising senior at Yale. So he was just before his senior year. He was working as and he was, they asked him to value a company. So he got stuck on his valuation, and he never calls me for advice. But in this case, he decided to call me. He said, Dad, I'm valuing a company. Maybe you can help. I said, maybe I could. And he said, they've asked me to do a 3-statement forecast. You know what that is, right? Forecast the income statement, the statement of cash flows, and the balance sheet. He says, how do I do it? I said, I don't know. I've never done it. He said, but you value companies. I said, I've never had the need to forecast 3 financial statements with numbers that I'm not going to use. I need 6 of those numbers. Why the heck would I be forecasting out receivables for the next 30 years? It's one of the biggest wastes of time I've ever seen in valuation. Valuation is full of these fluffy things that take up time, add detail, add nothing to your valuations. My valuation class, I said, look, less is more. Forecast what you need to, but not a single line item more. For those of you who've seen my valuations on my blog, I pretty much follow the same rubric. Almost every company I value, I'll give you the levers of value. Everything is driven by these levers. And think of any business model out there, and I can promise you I can find a way to fit it in through these levers. The first is your growth lever. To capture your growth lever, I'm going to look at revenue growth. Why? Because it's the most honest measure of growth. You can increase profits by doing accounting gains or making things look better, but revenue growth, you actually have to build. So start with revenue growth. Now already you can see, take ITC and Zomato, pick those by accident, but think of it. If I ask you, what's the potential revenue growth at ITC, your answer is not much. Why? Because even though cigarettes are a nice addictive product and you can sell them, the growth is kind of capped off. You're not going to grow at 15, 20% a year. And in countries like the US, if you look at Philip Morris, the revenue growth is actually negative because older people continue to smoke, younger people don't. Philip Morris tried to build by vaping, but that didn't work very well. They got rid of it very quickly. So revenue growth is going to be negative. So this notion that some of you good management, you can make any company's revenues grow has to be let go. Depending on the business you're in, depending on how old you are, revenue growth captures your growth potential. But revenue growth alone doesn't make you a valuable company. I gave Zomato incredible revenue growth. I drew on the fact that India could grow, people could eat out more. But if all they had were growing revenues, they're going to crash and burn. Why? Because they're losing money. So the second input I need is a measure of profitability. And I capture that through operating margins. Keyword is margins. They don't have to be the same every year. Where are you now? Where do I expect to be? Revenue growth captures the growth part of your business model. Operating margins capture the profitability part. And then I complete the cycle. I say, hey, growth doesn't come easy. Tell me how you grow. You say, what do you mean, how do you grow? You can grow with internal investments in plant and equipment. You could grow with R&D. You can grow by acquiring other companies. I'm completely agnostic. You say, but accountants wouldn't allow it. Who cares what accountants think? Let them do their job. I have a different job to do. I have to value companies. Accounting has to dot its I's, cross its T's, follow 5,000 different rules on what they can or cannot do. I'm not constrained. So accountants can say, you can't capitalize R&D, but I can do whatever I want. So the third variable that captures how efficiently you deliver growth, I capture by looking at how many dollars of revenues you get per dollar of capital invested. The more dollars of revenues you can get per dollar of capital invested, the more efficiently you're delivering growth. It's an insanely efficient way of capturing almost every business model. Think of whatever company you want to think about those three inputs. You captured the essence of every business model. You say, where does risk show up? In a discounted rate. There's one final loose end you need to tie up. When you project out your free cash flows of the firm and discount them back at the cost of capital with nirvana hanging out there in your terminal value, you know what you're missing? That you might not get to nirvana. What am I talking about? When you do a discounted cash flow valuation, you're valuing the company as a going concern. You're assuming it'll make it through good times and bad times. Its earnings might go up or down, but it stays in the game. What's the danger of doing that? Do companies sometimes go out of business? Absolutely. In fact, it's explicitly outside. I say, what's the chance my company will not make it? And what will I get if that happens? If Zomato doesn't make it, what do you think you're going to get as liquidation value? What are you liquidating? There's no physical assets. Failure risk basically means, as equity investors, you walk away with nothing. That's it. You give me a non-financial service. Financial service company is a little messy. Why? Because debt to them is not a source of capital, it's raw material. They're regulated. So it's not that they're more difficult to value, they're just different. For non-financial service companies, think of any company, and I can push it through this. This is my generic way of thinking about valuation. It's also my way of thinking about what DCFs are trying to do. That base year cash flows you have capture the value of existing assets. The growth rate and the reinvestment you use capture the value of growth. The risk you have shows up in your discount rate, and your terminal value tells me when you. I'm a great believer that every valuation tells a story. You might not realize you're telling a story, but I can see the story. And I'm going to play the story back to you. And you say, I don't like that story. I'm going to say, that's the story you're telling me. It's an exercise I go through with every person in my valuation class. Because when they turn an evaluation, I write their story for them. And I say, is this the story you meant to tell? And they said, no. Then I said, you have a problem with evaluation. Because every valuation you're telling a story about growth and margins and reinvestment. And that's what I want you to remember. You might turn in an Excel spreadsheet for valuation, but step back. Think about what is the business model I'm reflecting with my inputs. Do I believe that that this company can pull off this model? What are the dangers in this model? It's common sense. It's business sense. So about 4 years ago, I am, I'll be quite honest. One of the things that that I've been watching over the last 4 decades is Now, I'll give you two things that are happening that by themselves sound like good news. When I did my first valuation, I valued the company out of an annual report. And you know how I got the annual report? I wrote to the company and they mailed me an annual report. He said, why don't you go online and download it? This was 1981. There was no online, there was no download. You just had to write to the company. And if they were feeling in a magnanimous mood, they sent you the annual report. Didn't have to. Remember, we were a shareholder, you were not entitled to it. Today, if I have to value a company, I can not only download the last 20 years of annual reports, I can download all the data I want for every company in your sector and do it all in about 15 minutes. So clearly we have more data than we ever had access to 20, 30, 40 years ago. That's good, right? We also have more powerful tools. I told you, I did my first valuation with the pencil, the calculator, and a ledger sheet. You have Excel, you have macros, and you could write Python. I mean, you could go crazy with this stuff. So we have more data and we have more powerful tools. If I ask you, what does that mean for the quality of valuations? What's your answer going to be? Valuations must have become much better now than 40 years ago. As somebody who's been looking at valuations for the last 40 years, the opposite has happened. Valuations have lost their moorings. And I think part of the reason is we're no longer valuing companies, we're doing financial modeling. That's what valuation has become. You take a valuation class, you open up an Excel spreadsheet, you're off to the races. Now, how often I've opened an Excel spreadsheet in my valuation classes? Zero, never, ever. To me, once you do that, you've lost the game. So I started asking, what's missing? And what I think is missing is people have lost the art of storytelling. Now, one reason I wrote my book, Narrative and Numbers, I think there's an Indian edition of the book, is precisely for that reason, is because I wanted to talk about how every valuation tells a story, and you start with the story. A good valuation is a bridge between stories and numbers. What do I mean by that? You show me a valuation of a company, could be Zomato. Show me revenues in year 10. And I say, why are your revenues 20 billion in year 10? I want a story about Zomato that justifies those revenues. Maybe your story is they're going to go to grocery delivery, that they're going to provide consult. So I want that. I mean, I'm not going to reject your story. It's your story to tell, but I want to know that you've thought through a story rather than saying, I used a 50% growth rate for the next 10 years. That is not a story. That's an excuse. Every number in your valuation has to have a story behind it. Why are your margins 30%? Don't say because of the industry average. That doesn't answer my question. Tell me a story of why your company is going to converge with the industry average and why the industry average is not going to change over time. Good valuations are bridges between stories and numbers. Because each of us naturally has something we're comfortable with more than others, right? I mean, some of us are natural number crunchers. I'm a natural number cruncher. I like numbers. I like closure. It's my weakness when I value companies, is I have to fight that urge, get closure, see something that wraps it up. I have to force myself to tell stories. And I'll give you good news. If you're a number cruncher and you keep telling stories, it will get easier. The first time will be like pulling teeth. It will not come naturally to you. And if you're a natural storyteller, numbers will create the discipline to keep you from telling fairy tales. So whenever I hear a buzzword, you know what I mean by a buzzword. Somebody says, this will increase value, ESG, strategic factors, big market. The question I ask is, where in my story and my numbers would this play out? I call these weapons of mass distraction. Not destruction, distraction. Because people throw words at you after you've done the valuation. You know why? Because they want you to add a premium. What about great management? What about this? What about that? If you want to talk about it, I want you to incorporate the story and show me what number reflects it. It's the value of a brand name. What is the value of a brand name? Anybody want to try? Every company that you walk into claims to have this great brand name, right? What does that mean? From a valuation perspective, what's the value of a brand name? Anybody?
So
go ahead, yes.
So goodwill, maybe like whenever a company is actually acquired, so apart from the company valuation, how much they can pay over that?
You're basically saying brand name is whatever people will pay for it. That sounds like we're going in circles there, right?
So goodwill.
Because then it's not showing up in your cash flows, your growth and risk. The fact that somebody pays for it doesn't make it valuable. What's the value of a brand name? Yeah, Tindra?
Yes, sir. So probably if 4 or 5 brands of a similar sector is provided to me, what is the probability that I'll go for a single brand? So that might be the brand equity of a company.
What if I just say it's 20? There are 5 brands, it's a 20% chance. It's a random choice. It's not just that you will go for it, but that you will pay a higher price for exactly the same product. You know, you want to see the power of brand name at play? Walk into a pharmacy, pick up some aspirin. I don't know whether in India you can get Bayer aspirin, but if I walk into a pharmacy here and I pick up aspirin, I can pick up Bayer aspirin, which Bayer, of course, originally created aspirin, or I can buy the generic aspirin, the local, drugstore's version of aspirin. You know what the ingredients are? Exactly the same. Bayer aspirin sells for twice the price of generic aspirin, and people pay for it. Why? That is pure brand name power. Brand name allows you to charge a higher price, and people are willing to pay it because, for whatever reason, psychologically, you've trained them to do it. It's mind games. And that's not a bad thing. So, you know where it shows up in valuation? You have pricing power. What's the input in valuation? I gave you the business story part. So which of these inputs reflects? So if you have a brand name company, where do you see it in your story?
Operating margin.
It will show up as much higher margins for this company than the margins of the sector you're in. That's what brand name allows you to do, is to charge higher prices for exactly the same product. So let me ask this question about ESG, and then I'll open up to Q&A. What's the story here about ESG? If you are a good company, you will be worth more. I said, okay, I'm willing to listen. So I said, where? Where is it going to show up? So you see what I mean by where? If there's one version of ESG, and I'll come to I'll jump ahead, where the argument is that good companies will be rewarded. With what? Companies will buy more of your product. Their costs will get lower over time. Maybe even your risk will be less. So could ESG be good for value? Absolutely. So one vision of the story is maybe ESG will be good for value. By being good, you grow faster, you have higher margins. The second version of ESG is much more punitive. You know what that version of ESG says? Bad companies will be punished with what? Higher costs of equity and higher costs of debt. The bankers won't lend you money, stockholders won't buy your shares. So you can see already ESG is following a very religious path, right? The good shall be rewarded is one argument. The second is the bad will be punished. I'm open to that. Is there a third possibility? I call this hell on earth, where the bad companies actually walk away with higher values. Can you visualize a world where I can? Maybe bad companies cut corners and have lower costs than the competition. Maybe bad companies are willing to mine in parts of the world where you have to violate local traditions and environmental, but you can get away with it because it's legal. I can see. So my first reaction to ESG is, why are you walking around telling every company that being good is good for value? Because that's a lie. We know that it can be good for value for some companies. It can be neutral for value for other companies. And it can be bad for value for other companies. My problem with ESG is people don't seem to want to tell the truth. They're so busy selling that they're covering up the reality that it can't be good for all companies. You see, what about as investors? Let's say, you know how in courts you say, I'll accept your proposition. Let's accept the proposition that goodness, being good as a company increases value. Does that mean as an investor, you're going to make higher returns on this company? Actually, the reverse is going to be true, and here's why. If everybody thinks that good companies are worth more, what's going to happen to the price? It's going to go up. You buy at the higher price. Guess what? You're going to make lower returns than everybody else. In fact, the sales pitch that's being made to companies that ESG is good for value is actually going to cut against investors earning high returns, because if it's good for value and price gets pushed up, you'll be paying a higher price and earn a lower return. So ESG can't be good for both companies and investors, but right now, guess what? The pitch is it's good for companies, it's good for investors. So I did this for an ESG group last week, and these are true believers in ESG. They fought back, but eventually they gave in, and they said, finally, they said, okay, maybe it's not good for value, maybe it's not good for investors, but it's good for society. I said, really? So you want Jamie Dimon and Larry Fink deciding what's good for society? Isn't that what we've done with ESG? We've turned over choices on goodness to CEOs of companies and people running mutual funds. Think about it. Do you want the Ambanis deciding what's good for society, or Tata's deciding what's good for society? You say, but somebody has to. You know who the person is? If you're concerned about climate change or poverty or inequality, that person is you and I. This is, I think, an abdication of basic responsibility that we have as citizens. We still want to drive our SUVs. We still want to crank up the air conditioning. We still want to get convenience at a low price. And we still want the world to be a better place, but we don't want to bear any of the inconvenience with it. So I say, let the companies do it for us. It is not going to work. Companies are very inefficient mechanisms for delivering goodness. You know what they're going to do? They're going to create this illusion that we're all on a pathway to being good. We're all going to say, okay, we don't have to do our job. We don't have to do anything on our part to do this. We don't have to vote for the right people. We don't have to buy the right products. ESG to me is a reflection that we don't want to make those hard choices, so we kind of outsource them. 10 years from now, here's what I would predict. Companies will still be bad companies, perhaps worse than they are today. Investors will still make low returns. Society will not be better off, but there'll be one group that's enriched by ESG. You know what that group is? Bankers, consultants, and portfolio managers. This is a boondoggle. Lots of people are making money on it. And when lots of people make money on a concept, they'll find a way to make it look good for everybody. So I'm supposed to give this talk to a group where Larry Fink is going to be in the audience in a couple of weeks. Let's see how he takes it, but it'll be fun. I'm looking forward to asking him to his face why he's such a hypocrite. And you manage $9.5 trillion. What made you go? Who the heck are you to make the judgments on goodness and badness? It's not your money. You're running a bunch of ETFs of other people's money. How do you reconcile your fiduciary responsibility as a portfolio manager with your claims about being the arbiter of what's good or bad? So I'm going to end with that. I know there are 51 slides. I never expected to get through them, but you kind of get the framework, right? No matter what concept gets thrown at you, take it through that mechanism. Where is it going to show up? And you can't think of a place. Guess what? People are bullshitting you. So give it a try, and I'm going to open up the Q&A. Shrek?
Yeah. Can you hear me? Sir?
Yeah, I can hear you.
Thank you so much, first of all, for taking some time. It's an honor to have you, sir. So my question will be a little longish. I have some examples which will act as a devil's advocate to the fact that yes, ESG is important. So the PE firm True North recently said that it's going to invest only in ESG compliant companies. Temasek, valued its carbon emission to $42 per ton. So they are trying to value it and integrate into the system. Companies are talking about ESG integration, and we have seen enough examples like Pacific Gas and Electric Company filing for bankruptcy because of the wildfires in the United States, the BP oil spill in the Gulf of Mexico, the Volkswagen fiasco that we had. So
but wait. None of those have anything to do with ESG. Why is PSG? Because the traditional legal system came down. That would have happened with or without ESG. If you look at Exxon, at the Valdez oil spill of BP, that had nothing to do with ESG. They paid a huge cost before ESG was even an issue. So you can't go back retroactively and claim credit for things you had nothing to do with. Right? So when you look at companies getting punished, you are actually providing a reason why ESG shouldn't even be needed, because you're saying, look, these companies got punished. There was nothing to do with ESG. Look, the traditional legal system came after the PSENG when it created fires and it's made them bankrupt. Why do you need ESG then to punish bad companies? So I think that the argument you're making is the traditional system, the legal system. You know why though? I mean, the one thing I will concede is the one area of success ESG has had is fossil fuels, right? It's punished them. Let's face it, energy as a portion of market cap is half of what it was 10 years ago. You know why it's happened though? It's a one area where there is at least some consensus forming about goodness and badness. There are holdouts, but I think climate change, we're all saying that's a bad thing. So the reason it's worked is the consensus is this is bad. Though you have to be careful, because if you drown people in disclosures about carbon emissions and carbon footprints, you know what happens? I wrote a post on disclosures a few weeks ago. I said, if you really want to drown people with bad stuff that they will forget, drown them with a lot of bad stuff. How many risk factors did Zomato list? 59. By the time you get to 43, it's all swimming together. The big risk, the small risk, the minor risk, the non-risk. In ESG disclosures, it's exactly the same thing that's happening. Companies are drowning you especially in carbon footprint disclosures. And people are just becoming numb. I'll give you an example. You know what? That when I buy an airline ticket on United Airlines now, I didn't realize this until a few weeks ago. They give me at the bottom the carbon footprint that will be created by this flight. So actually, when I was with the ESG group 2 weeks ago, I said, you guys all care about climate change, right? They said, yes. And they said, you factor in carbon footprints in your decision-making, right? I said, yes. They said, yes. I said, do you know that US airlines are all now reporting the carbon footprint? And they said, no. They said, is that happening? That's good, right? And I said, when was the last time you picked a flight based upon it having a smaller carbon footprint? Not one person in there had done it because it had become part of disclosure. So I think that this notion that somehow forcing companies to disclose more ESG stuff is going to make companies better is missing a fundamental reality of human beings, which when you drown in information, you know what we tend to do? We go back to simplistic rules of thumb. Basically, we give up. And my problem with ESG is 10 years from now, you're going to have half your annual report telling the world how good you are as a company. And nobody is going to be even reading that part because they've given up on it. So I think that you got to be very careful about the anecdotal evidence that's presented for ESG. And I'll tell you, the evidence that we've accumulated so far, it's not anecdotal, the empirical evidence is that if I were to advise companies, my advice is don't be bad. Being bad has consequences. It creates potential for catastrophic risk. I mean, there's a reason I would never invest in a Vedanta. The company plays too close to the edge. It's only a matter of time before something bad happens and it affects my value through that failure risk. So if you ask me to give advice to a company, I say, don't be bad. Don't walk too close to the line. Don't do things just because they're legal. And I'm not saying this as a moralistic thing. I'm just saying as a valuation thing. If you walk too close to the edge, you're increasing that risk of catastrophic risk, and that can lower your value as a company. So I'm willing to give that advice. You know what advice I'm not willing to give? Spend extra money to be good. That's the part where there's zero evidence right now backing you up. So I think that to the extent that you can point to individual examples, you can. But it's actually very difficult to look at the cross-section across the entire, it's basic statistics. I can always find anecdotal evidence to back up whatever I want to say. But across the cross-section, if you look at the evidence right now, there is very little evidence that being good makes you a more valuable company. Not being bad, I think there is enough evidence accumulated that you can tell companies don't be bad. Being good, not so much. Saurabh?
Good evening, sir. An absolute honor to join this session with you. My question is relating to this entire field of do good for businesses. Like we've seen over history, there have been concepts such as B Corp, triple bottom line, and now there's ESG as well. So do you think that there is it's a continuation of these trends that have been happening when it comes to...
It used to be called CSR and used to be called balanced scorecard. I mean, I've seen this game play out.
What do you think is different this time, or is it just the same?
Well, I think it's much more broad-based. I mean, that's clearly, it's the old days, it used to be individual companies that adopted it. It's now the wholesale buying into of big investment funds like BlackRock, right? Like the Business Roundtable in the US, which is the CEOs of the largest companies, 2019, they released what I thought was the stupidest statement I've ever read, which talked about stakeholder wealth maximization. Absolute crap. Because you know what it means, right? If you try to keep everybody happy, you know what happens? Nobody's happy. It's a rule of it's a rule of all humanity. You can't keep everybody happy. Business is about making choices. I think this is and that's what scares me. It's almost like corporate America, corporations around the world, not just in America, and in the investment community, have bought the concept. And it terrifies me because they're going to find a way to essentially become part of their marketing. And I think that's the difference this time around. And I think they're feeding into, I think, a desire all human beings have, which is, you want to do good, but you also want to make money. I mean, that's reality, right? We all want to do good, but we don't want to be poor. And ESG promises you that you can have your cake and have no calories. You can be good, but you can go into banking. You can be good, but you can work for McKinsey. I've released you from that constraint from 40 years ago, right? You either work for McKinsey or you go work for the Peace Corps. I'm saying you can go to work for McKinsey, act like you're working for the Peace Corps. So who's paying for this? But you can see why it's so popular. It allows people this, go work for a bank, you can make $200,000 a year, and you can call yourself a good person because you work only with ESG companies. How convenient. Yeah. I'm sorry, we have a follow-up question?
Bhargav has, I think, something there.
Okay, Yashwant, go ahead.
Yes, sir. So ESG is almost these days enforced onto companies by government policies and regulations.
That's different. That's different. If it's enforced, then it's not ESG. Then it's illegal. In fact, that's a good thing, right? If you want something, and presumably if you have a democratic government, you voted for this government, and the government says this is bad, we're going to make it illegal. Right. That's the way it's supposed to work. ESG doesn't work that way. It is, you're not passing a law, but you're telling companies, even though there's no law against it, we wouldn't want you to do it. That, I think, is what I mean by the abdication of responsibility. Either do the damn thing or don't do it. Don't dance around the edge and say, we don't want to pass the laws because it's too much backlash. Why don't you guys do it for us? That's basically what we're telling companies, right?
Exactly.
It's not going to work. It'll be like having a system, and India already has this, of crosswalks, and nobody, you can walk wherever you want. You know what? People walk wherever they want. You can tell them, but you should be walking just on the crosswalk. If nobody is enforcing it and it's not against the law, you're going to do whatever's convenient.
Right.
So I think that you can, what you're getting is a lot of lecturing of politicians, politicians are the last people in the world who should be lecturing other people on morality and ethics, but they're lecturing companies, you should be good, you should do this. But no, you know what, we're not going to pass the law that requires that, because this is so convenient, because we just tell you and you do it. So I'd like it to be a law. If you really mean this, pass the damn law. Don't be passing this on to companies and asking them to do it, because it's like a placebo. That's basically what we have here. It's a placebo where we think we've all done the right thing, but nobody's bearing the burden of actually doing the right thing. Sata?
So just one follow. The notion behind ESG was supposed to be like giving back to the society per se, isn't it? But it doesn't feel authentic. It almost feels like a marketing gimmick almost.
No, wait. There's not. When you're a shareholder in a company and it does well, what do you get? You get dividends, you get price appreciation. Giving back to society is an individual decision. Nothing stops any of us from giving back to society. If you made a lot of money on Zomato, would you give back to society? Yes. Deepinder Goyal could take half his wealth and give it. What Warren Buffett? Warren Buffett has promised 99% of his wealth will end up in charity. You know what we've done though is we've essentially delegated this decision of giving back to society to Jamie Dimon and Larry Fink. They will decide for it. And you know the danger of doing that, right? What if they decide to give to the Met in New York City, one of the richest museums in the world, because it gives them prestige? I mean, they say, we gave back to society. Look, we gave $10 million to Met. And you're sitting there saying, that's not what I would have given it to. We've essentially taken a decision that you and I, as shareholders and companies, should be making individually on how much to give back to society and who to give it back to. There's no window that says society that you go give it to, right? Giving back to society, you have to pick what part of society you're going to give it back to. Right now, we're letting corporations decide whose society is and where they give it back. And that's not healthy. It's not their money. They're being generous with other people's money. And guess what? If you need the dividends to buy groceries, you deserve to get those dividends to buy the groceries. You're not wealthy enough to give back to society yet. If Jamie Dimon said, look, I took your dividends and gave them to society, and you're starving in your house because you can't buy groceries. In what world is this a fair outcome? So I don't think that ESG and giving back to society, they're not mutual. I mean, I can give back to society with ESG, without ESG. We've been doing it for 150 years as in shareholders and companies. So for ESG people to say, look, we are going to give back to society for you, I think essentially it's an extraordinarily elitist view to take. Because basically what does it say? We don't trust you to make that decision. We're going to do it for you. And if there's something that you worry about that companies will not be able to do right, then pass the law. I mean, that's why for environmental laws, you pass the law, because you can't leave it up to companies to decide what laws to follow and what not. Karan?
Good evening, sir. Thank you so much for spending your valuable time with us. I would like to requote a statement that you made, that companies are very inefficient mechanisms to create goodness. But at the same time, I feel that they are more powerful change agents as compared to individual consumers or customers. So my question is, if ESG is a buzzword, then what is the alternative? And I would also like to take an example of a particular industry in India, the ready-to-eat food products industry. The plastic, there almost everything is packed into plastic, and this industry is rising at a CAGR of 8.9% in India. Whereas if we see the plastic recycling capability of Indian government, it's only at a growth rate of 3.3 CAGR.
What's the easy, Karan, before you go on, what's the easy fix to the problem that plastics create garbage?
Sorry, sir, can you say it again?
What is the fix to the problem that plastic? I can say to you, I mean, you would drive through India, you see mountains of garbage, and you're pointing to the source. Everybody So if you
Yes,
want that to stop, rather than telling companies don't use plastic, what is the efficient solution?
the legal system.
Yeah. Forget the legal system. Pass a law that says you got to pack in recyclable material. Of course, the problem is when you pass the law, you're going to get backlash. You're going to, you might have people who contribute money to your party and they don't like it. But to the extent that you leave this to companies, here's what's going to happen. Some good companies are going to pack in recyclable materials, and presumably they cost more than plastic. That's why people are using plastic. And they're going to charge you, let's say 20% more. You see why I said eventually this rests with you and I? If you're comparing two restaurants, you're buying biryani at two restaurants, the biryani tastes about the same, and one costs 20% more, but it comes in recyclable packaging and the other comes in plastic packaging. I'm going to turn to you and say, how often are you buying the more expensive food? And if you're saying, well, it's cheaper by 20%, that's a big difference, I'm going to go with the plastic. Stop blaming companies for the plastic. Eventually, this rests on us as consumers, and this rests on us as governments to stop it. We can't pass this on to companies that you do it. It's not going to work. It's not that I don't want them to do it. It's not going to work. I mean, there's a law called Gresham's Law, which is about money. Bad money drives out good money. I'll pass a version of Gresham's Law on companies. Bad companies will actually beat out good companies. Restaurants that use plastic packaging will win against restaurants that use the recyclable packaging if we don't care. And that's the core problem. We want convenience, we want low prices, and we also want all this good stuff. And that can't stand.
So a follow-up question.
Yeah, go ahead.
So a follow-up question to this. So for developed economies, do you feel that it's a trade-off between the growth rate of the GDP and the goodness that the government is trying to create?
There might be. There might be. I mean, there might be. In fact, that's why I think governments don't want to do it. And can you imagine in democracy running for re-election after a minus 3% growth for the last 3 years? You can tell them, but I created a cleaner world. Will you get re-elected? The answer is probably not. So collectively, you can see that we all want the goodness, but we don't want to do what that'll require. Being good has always required sacrifice, giving up something. And that's what I never understood about ESG, because they told you can be good and be richer at the same time. I said, that's not the way the world works. Being good has always required sacrificing something. So if they've been honest up front and said, look, companies should be good, even though it means your value could go down. Investors should be good, even though it means you accept lower returns. I'd have been much more willing to give it a listen. But that's not what I'm hearing. Yatindra?
Thank you, sir.
Yes. Thank you, sir. Sir, we discussed about that the companies drive incentive for as their brand value through the operating margins. Sir, I feel the more value can be created if we try to lower the cost of debt or the cost of debt for the companies. If the PSU banks are giving the companies at a lower cost, at a lower lending rate. So I think that value can be created.
Before you go on, I've never seen a company that got great by lowering its cost of debt. Never. Growth has to come from above. If you think about this equation, it's got to come from the numerator. You don't get growth by finessing the denominator. Think of that as a general rule. That's why even, I do a corporate finance class and the right mix of debt and equity for a company. Let's be quite honest. If what you're focused on is finessing the debt to equity ratio, it's because your business model is broken down. You think Google spends any time wondering about whether it has the right debt ratio, what its cost of debt is? I don't even think they need a CFO. They say, who cares when you make 35% return on capital and you have 30% margins? We're going to go for growth and profitability. So one sign that your best days are behind you as a company is you're spending all your time trying to get your cost of capital to drop by 10 basis points or 15 or 20. You've lost the game. The game is over. So I think you can try to increase value by finessing those numbers, but this is going to be very marginal. And if you're doing it because in India, one of the problems is you can play it because banks are willing to lend you money at rates lower than they should be charging you. That's an entirely different. This is the exact opposite of ESG. You're creating costs for society to make yourself. So maybe in India, the message should be don't be bad. Don't be creating costs for society. And this is going to be a collective message, not just to the companies, but to the banks that lend the money at below market rates. Because every time a bank lends money to a company at a rate below what it should be charging, you know who's bearing the cost? You and I as taxpayers, because eventually the bill will come due. And it's coming due. Think of how many Indian banks that bill is coming due of bad loans from the past. Maybe we should start there. Forget about this good stuff. Just don't be bad. Just don't go out and create costs for society, because that, I think, is what we need to kind of get rid of first. Bhargav?
Yeah, hello, sir. This was an entirely new perspective for us. So my question is, you said spending for companies to spend extra money, it doesn't really add up to their profitability. And even your slides had some evidence of that.
On goodness. So basically, we spend extra money to put a green sculpture in your front yard, or you hire a diversity consultant to make your, I think all those flourishes that companies use, look how good I am, look what I'm doing. None of that really pays off as higher revenues. Nobody buys a product saying, you know what, I love that green sculpture they have in that front yard. That's why I'm going to buy the product. So that's what I mean about spending money to be good, paying consultants to come in and tell you how you can look good. It's called greenwashing. In fact, it's a word that's often used, but companies hire consultants to make them look greener than they are, more socially good than they are. There's no payoff to that. Consultants get rich. You have nothing to show for it. And by definition, if you have nothing to show for it and you're spending money, it's got to make your value lower.
Yes, sir. And you also give the example of plastic. If given a choice, which would you buy? So on those lines, so nowadays there's another buzzword called conscious buying. So let's say,
and I think that's a good one. That's a good one. I think that's taking personal responsibility.
Yeah.
Basically, to me, conscious buying basically means that people ultimately have to take responsibility for what they buy. The only problem is it's easy to say conscious buying. It's tough to actually act on it. So when you walk into that appliance store, are you willing to pay 20% more for a TV with roughly the same visual quality, but takes up 25% less power, or creates fewer side costs in terms of environmental costs? That is really where the rubber meets the road. It's easy to talk the noble game. It's much more difficult to play it because it'll cost you money.
So let's say if I have to combine it with another factor, let's say spending more on technology, let's say green building on green machinery, which are more energy efficient. So right there in this slide,
is the energy efficient saving enough cost? Wait, before you do this, we don't need to bring any ESG. Can that energy, let's say you put solar panels. You're not doing it out of climate change. You're doing it because the costs you save in electricity are greater than the cost of buying the solar panels. You don't need ESG to justify it. The test then becomes, if you spend the money on the panels and you save only half of what you need to, would you still do it? And if your answer is yes, then you're saying it's okay, I'm going to be a less valuable company. I'm spending more on energy than I should. And if you own the company, all the more power to you. But if you're the CEO of that company, I think you have an obligation then to go to your shareholders and say, look, this is what I'm planning to do. This is why I'm doing it, because it's other people's money. It's not your choice to make. It's not your decision to make, even though it makes you feel good. Transparency is needed here in saying, this is why I'm doing it. And that's the problem of it being voluntary. Right? Because then you're going to say, look, do I want to go in front of my shareholders and explain to them their earnings are down 10%, but the world is a better place? Because the same reason the politician who tries that gets voted out of office, the CEO who tries that is not going to stay on as a CEO.
So they rather not look at total cost of ownership and they just focus on.
And why is that? Because we as shareholders or we as voters don't care enough. That's why I'm saying the responsibility for goodness lies with each of us. It doesn't lie with the CEOs. It doesn't, in a sense, unless we're willing to act on those views and spend more money, accept more inconvenience, it will not happen.
So you say if that happens, so if we are more responsible, then this model will actually work.
See, ESG all you can do is act. So don't put the we in here, because all you can do is do it for yourself. You can say, look, I can't change the rest of the world. I'm going to go out and do the right thing. Because the problem is, if you say we, you're going to look around and say, but none of my neighbors are doing it. Why should I be the only one to do it? You almost have to say, look, I don't care what the rest of the world is doing. I'm going to go out and do the right thing. I'm going to be willing to spend more to get my food in recyclable material. I'm willing to spend more to put solar panels on my house, even though I won't save enough in electricity. And if we all made that I decision, there would be no need for ESG. Because you know what will happen then, right? Good companies will be more valuable because we'll be buying their products. We don't, all of this ESG push came back against the Milton Friedman 1971 New York Times article, where he said, if you run a business, you have a singular objective. You want to run the business as efficiently and as profitably as you can. It's not your job to be social conscious. And all of the ESG push was, oh, that's so terrible, that's so narrow-minded. And my reaction is, if your sales pitch is right and ESG is good for companies, Milton Friedman said, go out and be good. See, he's actually pointing out that your pitch is either a lie and you're lying to people about it being good, or it's true, in which case you don't need to displace Milton Friedman. Good companies will have a higher value.
Yes.
Ram, are we running out of time now?
Yeah, I think it's about 75 minutes. In case you want to, I really love the passion with which you are answering. In case you want to, you are.
I can go on for a few more minutes. So let me take a few more questions.
Right. So I guess there's one from Dakshan, and Dakshan. I think he's just messaged it saying, what criteria should people choose while creating an ESG portfolio?
Here's the problem. What's good for you and good for me are very different things. So if your measure of goodness is that you don't kill things, you know what? You should be not buying McDonald's, obviously, in your portfolio. You should be focused on companies that are vegetarian-based, vegan-based, basically. So that's, again, a problem with ESG, right? Unlike profitability or market cap, where there can be different definitions, What you define as good and what I define as good are very different things. In fact, I start this session and show it to you with a list of 10 companies, and I ask people in every group that I show this to rank the companies from best to worst. And I include companies like ExxonMobil, Tesla, Facebook in that list. So about a third of people, wherever I go, pick ExxonMobil. It's an easy target, right? Fossil fuel. And these people drove to the meeting in SUVs. They kind of forget that, which use gas, but that they forget. But the ExxonMobil is the bad guy here because they provided the gas that lets them run the SUV. But about a third of the people, actually, you know what company they pick as the worst company in the world? Facebook. Why? Because to them, privacy is the issue of the times. Do you see where I'm going with this? This is why ESG services will never be able to agree, because each one brings in different dimensions of goodness. Now, a few years ago, last year, actually, I was doing the session in Brazil and I got a lot of blowback on this. I said, do you want your companies to become the equivalent of churches or temples? Because that's what ESG is going to require, right? Debating what goodness is. So you're sitting there, you're a retail company, you're thinking about opening a store, and somebody says, is this a good investment? Not in terms of profitability, but in terms of goodness. You go around the table. You know what? You're going to get 12 different definitions of goodness. God help you. How do you make decisions in a world where one person says, what I value is privacy, the next person says climate change, the third person says poverty. You go around, you try to bring that all to the decision, you will never make a decision. It's going to lead to absolute paralysis. Or you're going to do whatever you want to do and cover it up, right? Under ESG, I did this. Why do you lose money? Because I had to do good things. We're giving CEOs essentially a shield against almost any type of critique you can have against them. So I think if you're going to build an ESG portfolio, start with your insights. You tell me what you think is good or bad, and then be true to that, right? So your ESG portfolio is going to look nothing like mine because your measure of goodness is not going to look like mine. This predates ESG, right? None of us was ever required to buy a company. Investing is a voluntary act. So if you wanted to build a portfolio of companies that met your version of goodness, you could. But that's not going to be the same as and that's my point about Larry Fink picking this for you. Because you send your money into an ETF, Larry Fink is going to decide goodness. And I'm not comfortable with that.
I guess it's ESG possibly is more about touching the inspirational appeal, that is the values part of the human beings, and trying to expropriate.
And I think values, but ultimately my point is human beings have values. Corporations are legal entities. Perfect. To try to endow corporations with those values is dangerous because you have thousands of shareholders, each of whom has a different value system. How do you create a consensus value system for a corporation that everybody can buy into? And that's the danger we face here when we try to ask companies to be good, is we can't make up our minds on what goodness means. And we're opening this door of companies then defining what goodness is for all of us.
So I'd like to take this opportunity to thank you on behalf of IIM Kozhikode, and I can only say that it's been a dream come true for me and for almost all the people out there here at IIM Kozhikode. And I'm sure all the participants, we've got in fact many investment bankers also attending in this particular, you can say, audience from India. And I'm sure we've all kind of got benefited from your discussion. Just hope that we get a chance to meet you in person someday sooner than later and get you invited to IIM Kozhikode.
Thank you.
That's the dream part of it. Wish you a great health.
One of these days, I haven't left this particular room in a year and 6 months now. I came here on March 6th of 2020 in the middle of my spring 2020 class from New York. I came back. I live in California. So I haven't left left home for almost 18 months, the longest stretch I've been home in a long, long time, but hopefully next year.
Yeah. Okay.
Thank you. And it was my pleasure, and be good. So don't take the message of this as you can go out and do bad things. This has nothing to do with individual. I think if there's a message here, it's individual responsibility. Anytime you pass this on, you delegate this, or you let other entities make these decisions, which we should be making as individuals, not only are we abdicating responsibility, it just doesn't work.
Yeah. Thank you so much, sir. Thank you.
You're welcome. Take care.